Over the past few months, there's been a noticeable shift in how investors are thinking about Europe. For a long time, it's been underowned, underappreciated, and in some cases, simply overlooked. But that's starting to change. Between rising geopolitical tensions, a renewed focus on self sufficiency, and significant fiscal support, Europe is stepping into a new phase, and with it, a new set of opportunities. And so, in today's episode, I'm joined by my colleagues Aneeka Gupta and Baoqi to unpack two areas where we're seeing the most clear opportunities: Europe defense and European infrastructure. Two themes that sit right at the heart of how Europe is reshaping its future and where investors may be more underexposed than they realize. I'm Mobeen Tahir, Director Macroeconomics and Thematic Research at Wisdom Tree. Anika is Director of Macroeconomics Research, and Bauchi is Associate Director Quantitative Research and Multi Asset Solutions here at Wisdom Tree. Anika, Bauchi, welcome to the show.
Thank you so much, Mabeen. It's a pleasure to be here.
Thanks for having me.
Great. So we've got two exciting topics to cover: Europe defense, Europe infrastructure. Anika, let's kick things off with you. We've been on the road lately, and I've heard your presentation where you talk about the theme, and you set the framing in the following way. You say that last year was all about budgets, and we know in 2025, NATO countries, particularly in Europe, were moving towards that new target, that 5% headline number broken down into the 3.5% core defense spending. And now you're saying it's about execution. So you start with this title that you're going from budgets to execution. Tell us about that shift. What does that actually mean on the ground when it comes to the European defense story?
Yeah, that's a great point. You're highlighting Mabeen for the outlook. In 2026 and moving ahead. On the ground, that means capacity expansion almost at an unprecedented pace. Take ammunition, for example. The EU ammunition production capacity rose from around 300,000 rounds per year in 2022 to an estimated 2 million by the end of 2025. That's an industrial expansion that far exceeds normal peacetime growth. A really interesting company, Rheinmetall alone, is targeting 1.1 million 155 millimeter artillery shells annually by 2027. That's up from 70K in 2022. And this is, we're referencing a time when we are rebuilding as opposed to, being in a direct confrontation mode here in Europe. I think the really striking development that I've been seeing evolving is in industrial conversion. Europe's deep civilian manufacturing base is now being repurposed for defense. The most prominent example that stands out to me is in Renault. Mabeen and Bauchi, you would typically, think of Renault as being operative in the auto sector, but you'd be surprised to know in January of this year, Renault announced that it would produce long-range strike drones, codenamed Chorus, in partnership with the defense firm Turgis and Gaylord, and they're producing this primarily for the benefit of Ukraine. So the goal is to produce around 600 of these long-range drones a month, with a potential 10-year contract valued at over €1 billion. So that's a car company becoming a mass producer of military drones, applying their expertise on the automotive side, their quality control, their cost discipline, their high volume assembly to the defense platform. Rheinmetall, a very well known defense prime, they're exploring ways to repurpose former automotive facilities for armored vehicle production. Volkswagen, another company that you both would typically associate with being in the automotive sector, is in talks with Rheinmetall about converting its Ossenbrook plant to tank production, to really help scale up production of ammunition and artillery. I think what we're what is resonating within the European architecture is that Europe's hidden advantage is in its industrial depth and automotive engineering, high volume assembly, be it that precision machining, and even machine tools. And these disciplines are now being applied and transferred directly into defense manufacturing. And I think that's where we're starting to see, the catalyst transforming from these long-term budget pipelines now being, transmitted into actual execution taking place on the ground.
It's very interesting you mention the involvement of Renault and Volkswagen and in the defense sector, and how you mentioned Rheinmetall. And this is certainly what we've been hearing from the companies on this show. Listeners and viewers would know we've been speaking to uh, Rheinmetall, Fincantieri. They all talk about these long-term increases in production and their capabilities. Of course, when we talk about the defense topic, Anika, geopolitics inevitably comes up. But what I'm hearing from you is this goes beyond the news cycle. Of course, 2026 has been all about further geopolitical risks and escalations. But is it fair to say that you're making a case that this goes beyond the news cycle, and this is indeed a multi-year structural shift?
Absolutely. If you look at the trajectory of European defense over the course of 2025, we started out with this immense amount of momentum in the start of Q1 of 2025, where we had the unleashing and the loosening of the German debt brake. Ursula von der Leyen coming out, saying nothing is off the table when it comes to defense spending. We had, companies across the defense realm within Europe really starting to contribute towards the long-term defense spending targets. But then we had these news headlines over the summer, which detracted some of that momentum, and it was very short-lived in our view. And that was around ceasefire taking place between Russia and Ukraine. Now, over the summer period, we saw that result in a bit of a trade-bound range, between over the of European defense stocks. But that was very short lived because we soon found out that we were very far away from obtaining a ceasefire between Russia and Ukraine. We then saw that the momentum come back into force, where NATO's new target was put into place of defense spending for European member states, rising from 2% to now the new 5% as a percentage of GDP. And that again provided tremendous amount of momentum within the European defense landscape. Now, if you fast forward to where we find ourselves today, in 2026, we have had a plethora of catalysts, that is necessitating the need not only to obtain these long term spending targets, but really to accelerate the defense spending procurement plan. And that is because we've had the US intervention in Venezuela take place in Q1 of 2026. We've also had the US threaten not to rule out military force when it comes to acquiring parts of Greenland because of its strategic importance. Now, at that point in time, Europe, European member states rushed to the Davos summit to obtain some form of agreement which would allow for Greenland's sovereignty and at the same time give in to President Trump's demands of acquiring parts of Greenland for his strategic reasons. But at that point in time, it was a very big wake up call for Europe, where they realized that without the help of the US, on their own, they were unable to actually defend their own boundaries and their own borders. And for us, that wake up call has really accelerated obtaining and reaching this multi year procurement cycle here in Europe. Take, for example, in the first quarter earnings releases from some of these European defense primes, we have been hearing announcements of very high order backlogs. And to give you an idea, Mubin, the order backlogs are representing the the existing outstanding orders that have not yet been converted into revenue backlog and have not actually been that are outstanding for that particular company. And if you take, for example, some of the well-known European defense primes, we've got Thales that has an order backlog representing 3.4 years of sales. We've got Leonardo, a very well-known European defense prime, again with a backlog amounting to around 45 billion euros. Konisberg, again, running a book to bill ratio of 1.61. So a book to bill ratio above 1 is showing you a higher expansion capacity, a rising order backlog for that underlying defense company. So it's giving you an idea of the outstanding orders that the European defense primes have yet to translate into earnings, the visibility of earnings momentum expected for those European defense companies. And it really gives you that important messaging that it isn't just the headlines that are propelling the European defense sector. We actually have a very concrete pipeline for the European defense primes, in the defense universe.
So, rising order backlogs and a multi year procurement cycle. Indeed, when we had the CEO of Rank, Dr. Alexander Segel, he used the term on this show, he used the term a defense super cycle as they see it, given the pace of new orders coming in for their company. Bauchi, you use something similar in terms of language when you talk about the European infrastructure story. You say that Europe is entering a new infrastructure cycle. It's interesting to see that terminology here, but why now? What's going on in the world of Europe infrastructure? What's this inflection point all about, and where does the case originate from?
Yes, that's a good question. So I know that when people talk about the European equities, like in 2025 and even now, one of the hottest topic is still Europe defense. And that is because during the NATO summit in 2025, the European leaders they gathered together and they announced that they're gonna spend 3.5% of their GDP in the defense spending. But a lot of people, that's why a lot of people think about, oh, now is a good timing to invest in Europe defense. But meanwhile, apart from that 3.5%, at the same time, they also announced that they can spend 1.5% of their GDP into the critical infrastructure. So that is actually strong tailwinds that why we believe now Europe is entering a super cycle. I would say super cycle, but a cycle for infrastructure investment. But spending or those kind of investment or commitment is more like just one side of a coin. If you more think about the demand perspective, why Europe needs the infrastructure. So over the last many years, there is actually clearly a investment gap in the infrastructure sector across Europe, and that actually has two, I would say, um, um, I would say there are could be some two aspects. The firstly is that the aging assets, because of there's a huge investment gap, there's a lot of aging assets in the infrastructure sector across Europe. Let's take power grid as example. The average age of power grid across Europe is around 50 years. It's much older than those in the US, in China, in Japan. But if we look into the power grid systems, a lot of key components, their design lifetime is less than 60 years. What does it mean? It means that it's quite necessary for Europe to spend more money to invest in power grid and upgrade them and replace the aging assets. That is just one example for aging assets. But on the other hand, the story is not only about aging assets. It's all about the new demand for the new infrastructure. Now is a changing world, and a lot of things are quite different from what it was 20 years ago. Let's take AI as example. When people talk about AI computation, people only talk about two countries, the US and China. Where's Europe? So Europe needs to keep its position in the tech competition, especially in the AI competition. And it's not only about tech, it's like a broader competition across the whole world. And what is the backbone of that one to support that competition? infrastructure. So if you want to get better AI competitiveness, you need better data centers, you need better energy infrastructure to support that, you need better digital infrastructure to support that. So that is actually create a lot of new demand for Europe, for especially in the infrastructure sector. So I would say that yes, we have to see that those European leaders, they say they're gonna spend more into the infrastructure sector. That is more about the supply perspective. But meanwhile, for the demand perspective, we still see the demand because of the aging assets, because of the new demand in the new infrastructure to keep the Europe's position in the global competition. So that's why I believe that it's a good timing for Europe infrastructure. It's not only about defense, it's also about the rebuild the backbone of Europe economy. So that is infrastructure.
Makes a lot of sense. And 1.5%, like you said, going to critical infrastructure. You've mentioned power grids, you've mentioned AI infrastructure. I imagine those are two very important pillars. More broadly, if we think about Europe infrastructure, how would you define all the pillars of this theme? How do you paint a picture of what infrastructure actually means and where does the money actually need to go?
hmm Yeah, that's a good question. So, well, I'm an investment profession, so I'm trying to take it from the investment perspective. So if you go through those announced investment plan across Europe, some of them announced by European Union, some of them announced by individual countries. And you need, as an investment profession, for me, the question is, how do you create a investable opportunities from those investment plan, investment programs? And we go through all of the policies, all of the programs, you're gonna find out where the money flows, right? So currently, from my perspective, there are four key pillars for Europe infrastructure. So they are where the money flows to. So firstly is the renewable energy infrastructure. So basically, because now Europe needs more uh, supply of energy and also need more security in the energy supply. So they need to find the diversified energy supply, which is not only crude oil, it's not only natural gas. They need to get more energy supply from the renewable energy to support the electrification, to support AI infrastructure. So that's why we think that first pillar should be the renewable energy infrastructure. And secondly, because you already have those, if you have already have those energy supply, you're gonna also need the power grid to support that, to support those energy infrastructure. So that's why we believe that the second pillar gonna be the power grid. As I mentioned earlier, so power grid now, there's a lot of aging assets in the power grid systems. So it's also quite necessary to upgrade those aging assets. The thirdly is the digital infrastructure. So digital infrastructure, well, it could be like the backbone of the modern economy. Like it's also quite essential for Europe to keep its position in the tech competition. When we talk about digital infrastructure, that can be AI infrastructure, that can be telecom infrastructure. All of them need to be invested and not to be upgraded for Europe to keep its position in the global competition. The lastly, I would say is more like the traditional infrastructure, for example, transport. So transport is like something we can enhance the connectivities across Europe. Because when we talk about Europe, especially European economy, some people might say, oh, maybe it's quite fragmented because there's a lot of countries, different countries might have different ideas. But how do you connect them? Transport is a physical way to connect different countries across Europe and to increase that connectivity. And it's also most important one for defense. Like if you want to move those military assets, if you want to move your tanks, your artilleries, you're gonna need a better and more resilient transport infrastructure. So that's why I believe that those four pillars could be the most interesting pillars for European infrastructure, and those are the pillars where the money gonna flow to.
Excellent. So, four pillars where the money will flow. And of course, Anika, when we talk about flows of money, we talk about financial markets. And in the world of defense, we're always keeping an eye on new listings. And you were mentioning how even companies like Renault and Volkswagen are taking a more defense tilt. But equally, you have new entrants entering the public markets through IPOs. So we know that you've been keeping an eye on new IPOs in the defense sector. What's going on there, and who are the new entrants? What's the opportunity set, and what's the dynamic like in that part of the market?
Yeah, we've kicked off the year with a very successful defense IPO with the Czechoslovak group CSG, which is Prague based. It's an armored vehicle and munitions maker. They listed in Amsterdam on the 23rd of January. And what can I say, Mabeen? It was an implied 25 billion euro market capitalization. The stock surged in its debut session. Investors placed more than $60 billion in orders. That's 14 times the deal size, with a meaningful share of investors actually not being able to get an allocation in CSG. I was fortunate on the day of the IPO to listen into an interview by the CEO of Euronext, where he described the pipeline of IPOs in the aerospace and defense sector in 2026 to be unprecedented. And what that signals is twofold. The first is there's going to be a scarcity premium for pure play defense equity, and that's quite evident in the deal size that we saw, which was nearly 60 billion worth of orders for CSG. And the second is that IPOs are becoming a financing mechanism for the industrial phase of the cycle. So as we move from the budgets to the actual capacity execution, we're seeing IPOs becoming that important critical lever for financing mechanism. And this ranges across the funding capacity, the inventory, the tooling, the working capital to actually meet these multi-year order books that we, highlighted to for a number of the defense primes. Now, in practical terms, I would say as we see, similar to the what was echoed by the CEO of Euronext, as we see more listings, that should allow a broadening of the opportunity set beyond those well-known defense European defense primes that we are privy to and well accustomed to in that key enabling layer. So across the munitions, the drones, the sensors, we should see further expansions of offerings of these companies, and we're also likely to see that industrial conversion take place. So companies like Renault moving into drone production, which uses Europe's deep civilian manufacturing expertise to scale defense, to allow that capacity expansion to do it, because the primes alone cannot do it themselves.
So very strong demand from investors, certainly for IPOs, and certainly for existing incumbents in this space as well. But investors also ask, with all this demand and all these pledges for higher spending, where is the money going to come from? And there are the national budgets, and then there are um, broader initiatives like the Readiness 2030, SAFE, that you mentioned in your presentations. Talk us about these broader financing initiatives. How are they coming along? Where is the money going to come from as it relates to defense spending in Europe?
Yeah, that's a key question. And the way we look at it at Wisdom Tree is we strategize it according to four critical levers. So if we start with the most important one, um, Readiness 2030, originally known as Rearm Europe Plan, that is EU's most ambitious framework designed to mobilize around 800 billion for the European defense sector. Now, that works across several levers. The first will be fiscal flexibility. It is activating the National Escape Clause of Stability and Growth Pact, and that allows European member states to increase their defense spending via the European Commission. Now, as of February 2026, the Council has activated the National Escape Clause for 17 member states. And that has essentially given them additional budgetary room of about 1.5% of GDP, and that is annually through 2028. Then we have the Security for Action Europe, SAFE, which is comes under the acronym of SAFE. That releases around 150 billion loan instrument that really help countries invest in key defense areas like missile defense, drones, cybersecurity. SAFE was adopted back in May of 2025 and was the European Commission's first wave of national defense investment plans for 8 member states. That was released on the 15th of January 2026, where we saw that first lever of funding being released for those 8 European member states. We're expected to see that we did see the next wave of approval for another 8 member states take place in the middle of Q1 of 2025, and the first payments are expected to land by March of 2026. So essentially, by the end of this month, we are expected to see those payments land. Now, if we add on Germany's constitutional reform, which is really enabling uncapped debt financing above a percentage of GDP for defense, you really have that multi layered funding architecture that makes the spending trajectory a lot more durable and a lot less dependent on one single government's annual budget cycle. So I think we have the first two levers being Security for Action Europe, Rearm European Plan. Those are the main funding levers. And in addition to that, we would add on the European Investment Bank's private funding arm. And in addition to that, any of the remaining funds from the cohesion plan will also be allocated towards the European defense sector.
So all this but all this spending and funding being scrambled, I suppose, because for a very long time, and we talk about this at Wisdom Tree, there's been an underinvestment in Europe defense, and that's something that is being addressed now. Bauchi, I know you talk about something similar in the infrastructure sector. You talk about a significant investment gap, and that really lays the groundwork for further investment in the infrastructure space. Can you quantify it for us? Can you tell us how big that gap is? You've already outlined the pillars. It would be good to know what scale are we talking about in terms of how much money needs to go into Europe infrastructure spending.
Sure. There are a lot of different sources to do the estimation about the investment gap. But here I just want to quote a estimation from Boston Consulting Group. So in 2025, they just released a report to cover European infrastructure, to talk about the investment gap. And according to their estimation, Europe needs 12 trillion euro of infrastructure investment by 2040. But now we have already seen a lot of European countries, they announce their investment plan in the infrastructure. Is that enough? Well, according to their estimation, if Europe keep the current pace, it will still create another 5 trillion euro investment gap by 2040. So that's a huge investment gap. And if we look back, like from let's say 2014 to 2024, how much money is spent in investment to the infrastructure? That is only around 300 billion euro per annum. That's still a big figure. But think about that. If you want to get 12 trillion euro being invested in infrastructure by 2040, you basically need 800 billion euro per annum. So from 300 billion per annum to 800 billion per annum, that is a big growth. And even now, a lot of European countries announced the investment plan. They have started to do more investment into the infrastructure that still can't meet the gap. So that's why I say that the investment gap could be one of the biggest driver from the demand perspective. Without enough investment, they're going to create a lot of aging assets. They will create a lot of lagging in the new assets. So that is from the quantitative perspective about this question.
I think that's very helpful framing. It helps people visualize the scale of investment required in this space. Another parallel we draw, and that's why we're speaking about these two themes together, the defense theme and infrastructure, is of course the geopolitical side of things. And on the infrastructure front, we know that when it comes to the Ukraine conflict, a lot of people have been thinking about the defense uh, story. But of course, Bauchi, even on the infrastructure side, when there's been a conflict for so long, it's been 4 years and still we don't have an end in sight. What it means is whenever that conflict does come to an end, there will be a need for reconstruction, rebuilding, more spending over and above your business as usual spending to really rebuild everything that's been lost. So how does the Ukraine situation fit into the Europe infrastructure spending story?
That's a good question. Because so far there's no clear plan for the reconstruction because we don't know when the war will be ended. Maybe this year, maybe next year. But according to World Bank's estimation, what we do know that Ukraine gonna need a huge amount of money to spend in the infrastructure to rebuild their country after the war. So according to World Bank's estimation, that amount is estimated more than $500 billion. And think about where they're gonna spend about this $500 billion. There can be housing because we basically need to rebuild those residential buildings destroyed by the war. You basically also need transport. You also need the energy infrastructure to rebuild the country. So when we think about the potential catalyst from Ukraine reconstruction, we're probably gonna think about those companies that could benefit from those those segments. Like we're gonna rebuild the infrastructure in energy sector, in transport sector, and those construction firms from Europe or from US could benefit from that reconstruction story. And because now clearly Ukraine want to have a closer relationship with Europe because Europe is the biggest supporter of Ukraine during the war. And Ukraine is expected to join European Union after the war. So with that connection, with that closer relationship, I would believe that European construction firms that focus on the infrastructure construction, especially in energy infrastructure, transport infrastructure, could benefit from that story.
Excellent. So, Anika, we we talk about when it comes to this theme. Now, Bauchi is mentioning an underinvestment, a gap, and maybe that signals that not enough focus has gone on this theme, and more focus needs to go into this theme, and certainly it will going forward. But when it comes to the European defense theme, for quite some time now, certainly over the past year, 18 months or so, a lot of focus has already been there as it relates to investors, which means a lot of money has gone into this space as well. And a lot of demand for the companies in this space has been there, which means that share prices have gone up as well. And that raises a question, have investors missed the opportunity? Are valuations too high? Now I know you've articulated how new orders are coming in, and the book to bill ratios tell us that more orders are coming in, which means more revenues to follow. But how do you tackle this question from investors that after such strong performance in a theme over the last year or year and a half or so, there is still an opportunity for investors and the valuations don't look outrageous?
Yeah, that's a it's a really interesting point, Mabeen. As we know in the team, we've this is one of the most important questions we faced on the valuations of the European defense sector. Uh, like you said, the performance has been stellar, but what we try to emphasize on is what's not been priced in so far in within the European defense equity space. And what's not yet been priced in is the unique nature of the European defense sector. European defense contracts typically are very long term in nature, and given the the previous analysis that we've done on expanding book to bill ratios, rising order backlogs, um, the current valuations are representing the existing momentum within the European defense realm. What it is not reflecting is the incoming profitability that will be realized over time. And what we've done is we've tried to draw a parallel between current price to earnings valuation, which is quite high at this point in time for the European defense sector, but when we view it over the next 3 years and we view it alongside the earnings per share growth expected over the next 3 years, what we realize is for the European defense sector, we are starting to see an earnings per share growth rate in the high teens. For 2026 is expected to be around 17%, followed by about 20% for 2027, followed by another 17% for 2028. Now, as those earnings per share growth are realized, we gradually start to see the price to earnings ratio come down from very high levels down to the early 20s by 2028. So, what's very important to keep in mind is the unique nature of the defense sector, where these contracts are drawn over a long term. As the profitability is realized, that is when we start to see those valuations come down. Not because the price is coming down, but because the bottom line, which is the profitability of these underlying companies, starts to get realized. I think the other way we try to look at it is from a global perspective. If you look at the European defense set, it has amongst the highest earnings per share growth rate when you compare it to the international defense space. Right now, where we see valuations as being extremely challenging and hard to defend is in the US defense sector. US defense primes are trading at much higher valuations, yet at the same time, they have lower quality metrics, so lower return on assets, lower return on equity versus the European defense companies. And at the same time, if you look at the earnings per share growth, it's actually higher for the European defense primes. So, from an opportunity perspective, and what we don't see captured in the price is the European defense premium versus the US defense sector at a time when the valuations for the US defense sector are higher than what we see in the European realm. And I think the third key point, which was very interesting in 2026, is Trump's hard power pivot. In early 2026, President Trump made an announcement on the crackdown of U.S. defense companies, where he essentially said U.S. defense primes are paying inexorbitantly high CEO pay. Their dividends and share buybacks are also very high, and until they see a much more formidable and credible increase in production of arms and ammunitions, they need to curtail these exorbitant CEO pays and these high buybacks and dividends that are being paid out. So the European defense companies actually enjoy a bit more flexibility when it comes to their decision making versus the US defense primes that are currently facing quite a harsh crackdown in the defense realm. And that's where we see the opportunity. That's what we see not in the price at this point in time, and where we also see this urgency and this need for speed that that the European member states and the European defense sector needs to inculcate to obtain that independence away from key allies that we have been relying on for over decades.
So, speaking of European companies, you've mentioned a few examples, Anika, in a recent blog that you co-authored,
Right.
and let's pick a few examples from that. You talk about Rolls-Royce, fascinating company, does so many things from aircraft engines to nuclear power and indeed very powerful cars as well. But you describe it as a sovereign power provider. I fascinated by that term. What role does power and propulsion play in the world of defense and defense systems?
Yeah, you've hit the nail on the head. Mobeen, Rolls Royce isn't just an engine company. It's a sovereign power provider across domains. So, be it the submarines, the combat air, the enabling infrastructure that sustain both. On the naval side, what we are seeing is Rolls Royce has signed a very long 8-year contract with the UK Ministry of Defence that is spanning across research, design, manufacture. And it is providing in service support for the nuclear reactors that will be powering the Royal Navy's submarine fleet. That's worth about £9 billion. That isn't a one off order, it's a long duration industrial framework that is really ensuring that ongoing investment in advanced nuclear engineering. On the air defense side, what we did see is this focus on next generation systems. So, Rolls Royce is actually a propulsions partner in the well known Global Combat Air Program, or as we call it, GCAP. They are actually currently working on the next generation power and propulsion systems. Um, the critical insight that we found was they are now focusing on the sixth generation air systems that is not just about faster jets, but they're effectively flying power stations supporting the sensors, the electronic warfare suites, and the secure networking. So, the demand for electrical power, thermal management, advanced materials is going up dramatically. And Rolls Royce is sitting directly in the middle of that problem set. So, when we talk about power and propulsion in the next generation defense, it's really about that enabling layer, the ability to generate, manage, distribute that power across these increasingly electrified and sensor heavy platforms. That is really the challenge. And that's what Rolls Royce is able to go a step ahead and help solve that problem.
Yeah, the sixth generation uh, Global Combat Air Program, the Tempest, as it's nicknamed, certainly a
Yes.
fascinating project between the UK, Italy, and Japan, and others. And like you said, Rolls Royce powering that program. But Bauchi, when we talk about Rolls Royce, we often talk about small modular reactors and nuclear energy. And there's such a close relationship between nuclear energy and the AI themes. You mentioned how people think about US and China when they think about AI, but increasingly there might be an opportunity for Europe to become an important player in that discussion as well. How is that evolution happening? Do you see progress on the ground in terms of infrastructure spending on the theme of AI and data centers in Europe, or is all of that still in the future? And maybe that's an opportunity as well.
That's a fairly good question. So, if you think about the data center in the US, one of the story was quite hot in 2025 and also this year is the energy. Like Elon Musk, he spoke to the public many times that, oh, we need more energy supply to support the data centers because data centers going to consume a huge amount of electricity in the US. And if Europe wants to have this position in the AI competition, we will gonna expect that there will be a similar story in Europe. So more data centers means more energy supply. So in Europe, currently, according to Morgan Stanley's estimation, so the power consumed by data centers count for around 2.5% of the whole European power consumption. So that is in 2025, 2.5%. And that's gonna be expected to grow to 8% by 2035, which i.e. in the next 10 years. So that's a huge incremental energy demand, right? So that is only one segment. If you think about the whole EU, a lot of factors gonna affect the um, power consumption. For example, electrification. More and more people gonna start to drive electric vehicles. That's gonna also create a huge incremental demand for electricity. So overall, according to their estimation, by 2030, Europe electricity demand expected to rise by 60%. So all of these incremental energy demand gonna need from those alternative solutions, from those alternative energy, like renewable energy, like nuclear energy. Is that good timing for Europe to go back to crude oil? Is that a good timing for Europe to go back to natural gas, to buy natural gas from Russia? Maybe the answer is no. So how do you meet that incremental demand? Wind, solar, nuclear? So this can be something that Europe need to have to keep its competitiveness in the future. So that's why I have already seen some investment plan announced. For example, from the European Union's perspective, there are some plans, for example, called Recovery and Resilience Facility. So that is focused on the green energy and digital investment. Some countries they also have their national investment plan to uh, boost their energy infrastructure. So that is something we believe they're gonna have the money flow to in the future. But so far, I would say that the story is still there, but we just need more moments to see more momentum within that sector, within the data center stories in Europe.
So, speaking of momentum, and you mentioned the recovery and resilience, I imagine policy is inextricably intertwined with the infrastructure story, right? As it is with the defense story. You need policy support. That's where the momentum ultimately comes from. On the ground, what are you seeing from governments? Are you seeing more initiatives being announced? Of course, we've seen spending from Germany. We've seen these new budget targets, the 1.5% spending. But what do we need for this to really become an investment cycle? Are enough pledges being made, and are enough initiatives being announced to follow through on those pledges? What are you seeing is the situation on the ground?
So right now, I think there are a lot of investment plans have been announced, and some of them are from announced by European Union, some of them are announced by individual countries. And then both of those two kinds of programs are quite important. Like those EU programs, they make the Europe infrastructure more credible because they provide money, governance, and cross-border coordination that create investable pipelines. But meanwhile, the national programs they actually make the infrastructure this theme more scalable. So that actually turns those selective funded projects into the broader domestic construction cycle. So in the first group, we have already seen a lot of investment plan, like mentioned earlier, recovery and resilience facility that is mainly focused on the green and digital investment. And there's also another investment program called Connecting Europe Facility. So that adds more targeted layer for transport, for energy, digital infrastructure, especially the cross-border links that for that will enhance the collaboration among Europe. So I would say both of them are quite important, and both of them both of them are in the process for execution. And those European EU level programs, they actually enhance the cross-border coordination. But meanwhile, for those national programs, especially the national programs from Germany, they are more focused on their domestic demand. I think both of them can make the European infrastructure theme, more investable. You mentioned Germany. So Germany is quite an interesting case. It actually shows how Europe can be more decisive in infrastructure. In the past, Germany used to have a very strict fiscal discipline. Like there is a quite clear cap for their net debt. But in 2025, they actually leased that cap and set up they also set up a infrastructure fund for it's not actually not only infrastructure fund, it's actually for infrastructure investment and climate change. So the amount of that fund is 500 billion euro. That can be spent in the next 10 years. So we can see such structural shift in German fiscal discipline. And we're gonna probably gonna see such shift gonna happen in other European countries. Because both defense and infrastructure, these themes are driven by policy. If you already see a lot of shifts in defense sectors, and we are seeing a lot of shifts is coming in the infrastructure sector. So I would say yes, the program's there, and also both of them, both from the European Union perspective and from national aspects, both are quite important. They collaborate together, they enhance the investment, and also the recent shifts in Germany showed the shift that how Europe can be more decisive in infrastructure investment.
Okay, so Bauchi, there's a lot of policy support, and the case for the theme is strong. Uh, Very quickly, give us an outline of the value chain as it relates. Like you said, we're in the world of investing, so investors want to know uh, in terms of the opportunity set here. w- How do you define the value chain? What sort of companies are you actually looking at when you're thinking about the Europe infrastructure theme and story?
Yeah. So from my perspective, I mean, if you think apply the value chains methodology in the infrastructure sector, there will be three groups. So firstly, you have builders. The builders are like the construction companies. They build up the new infrastructure and also upgrade those aging assets. Secondly, you have suppliers. So these companies, they are like they're providing the key components or like building materials to the builders to support the construction process. And after that, you have the third group. The third group are like operators. So they are more like, say, utility firms. They don't do any new construction. They just operate those existing assets, existing infrastructure. But because right now a lot of the investment gonna flow to the infrastructure sector, that's gonna create some incremental opportunities, incremental investment. But how do you capture those incremental opportunities there? Operators? Maybe not, because they are more linked to the existing assets. We need to find out the companies that closely align with those incremental opportunities, incremental investment. So that's why I believe that the builders, the suppliers, they are more closely aligned with the construction, they closely aligned with those incremental investment. So they could be more likely benefit from the next cycle for Europe infrastructure.
Excellent. So, Anika Bauchi, let's get your closing remarks on a very important question we get all the time, which is in the context of the current environment where we have a conflict in Iran, and of course that raises the situation where energy prices have gone up, and there's a risk maybe inflation goes up, maybe rates remain higher for longer, maybe there's stagflation, all these terms coming up, and all these question marks in terms of the macro backdrop. And every investor is asking a question about every asset class and every theme and every topic. How does all of this relate to this theme? So, in terms of your topics that we've discussed today, Anika and Bauchi, Anika, let's go with you first. How do you see the macro backdrop affecting the European defense story currently?
Yeah, for us, Mabeen, we believe that European defense is a very interesting way to hedge your portfolio against these rising geopolitical risks. If you look at the European defense sector, we're seeing cash flow per share increasing over the next 3 years. We're seeing net debt levels reduce over the next 3 years, and we're seeing earnings per share growth increase progressively over the next 3 years. That gives you a sense that the European defense sector is offering you high quality, high growth at a time when growth uncertainty prevails, at a time where volatility is high. And a lot of that volatility is tied to geopolitical risks. So, for an investor who's looking to hedge his volatility in the markets, this provides you an interesting avenue to obtain that hedge against rising geopolitical risks.
Bauchi, for Europe infrastructure?
Yeah, I think in terms of the current situation, yes, there could create some volatilities in the short term. But now, because of the rising price in the crude oil, I think that's a good opportunities for the governments, for the European governments to convince the public is that now it's a time that we should increase our investment into the energy infrastructure. We should definitely find some alternative solutions apart from those crude oil. I think now is a quite good timing for the politicians. But if you think about specifically a broader picture about Europe infrastructure, so a lot of spending is actually led by the policy, led by those announced investment programs, and a lot of the demand is actually because of the strategic autonomy. It's not only about economic efficiency story. It's also about you want to get a more enhanced critical infrastructure to support a more resilient economy, more resilient logistic, more resilient defense sectors. So those are quite strategic. So they are quite harder to defer, especially in grid, in electrification, in the digital backbones assets. So I would say maybe in the near term, the macro could create some volatility in the market, but in midterm, the backdrop it's actually become more supportive for Europe infrastructure spending with more political support.
Excellent. So we were talking about Europe infrastructure and Europe defense with Anika and Baoqi. At this point, I have to thank you both for your thoughts and insights, and we have to thank everyone for tuning in. Before we close, I do need to state the following to clarify: the views and opinions expressed in this podcast are those of Wisdom Tree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. We hope you've enjoyed this episode of The Next Big Thing. And if you want to hear more from us, please subscribe on whichever platform you're using and do take a moment to leave us a 5-star rating. You can, of course, follow us on LinkedIn or X, Wisdom Tree in Europe, or us individually. And if you want to learn more about megatrends, visit Wisdom Tree's website. And with that, we hope that we will see you all again for another interesting conversation in the next episode. Thank you very much.